Good afternoon, everyone. We appreciate you joining us. As always, we have a full presentation today, so let's go ahead and get started. I would like to first start by introducing our team members. We have Milt Folan, Kevin Fix, Paula Miller, Justin Seidenwan, Kelsey Fogel, and myself, Brianna Beck. As always, we have disclaimers. This presentation contains the most current information that we have available. However, we are in a very fast-moving environment. We verify all of our information and obtain it from what we believe to be reliable sources. Much of the information we use, however, is subject to revision. This presentation is not intended to be used for personal tax or investment advice. However, our clients know that we do provide such advice routinely, but when we do, it is in the context of your financial plan and we have your financial details in front of us. I would like to note that Kevin and Milt have again received the 5-Star Wealth Management Award for 2023. You make this award possible with your continued support, and for that, we are truly grateful. Here is an outline for today's presentation. We'll start with Justin. He's going to provide us with some information on Schwab Alliance. And Kelsey will get into Dropbox and quarterly reporting. She will also discuss some of the cash management opportunities. And then we'll have Milt move to a recap of the markets in 2023. Kevin will review some of the key market indicators. And lastly, we'll conclude with some Q&A. We have allotted some time at the end of our presentation for Q&A. However, feel free to ask your questions using the Q&A feature at any time. Many participants have sent us questions prior to this call, so we'll be sure to answer those questions as well. With that, I'll pass it over to Justin to go ahead and get us started.
Thank you, Brianna, and thank you to our clients for giving us your time today. Before we get started, we have a quick poll question here. So you should see it popping up on your screen here. The question is, have you reviewed your contact, phone number, address, etc. information, beneficiary information in Schwab Alliance? Yes or no, but I plan to after this call. So if you'd like to respond, you can just click one of those options. So we'll give folks a minute here to respond. Okay, and it looks like about 73% of you are already enrolled in Schwab Alliance. A few of you will log in after the call, so that's good to see. More information on Schwab Alliance coming here. So I just wanted to spend a few minutes talking about Schwab and some of the things you should be aware of. As you know, we went through a conversion from TD Ameritrade as our custodian to Charles Schwab in fall of 2023. While the conversion itself went quite smoothly, there are some minor differences between Schwab and TD Ameritrade that may affect you as a client. I'll spend the next few slides highlighting some of these changes, as well as how you can utilize the Schwab website to your benefit, including some features that Schwab offers on their client website, Schwab Alliance. First, as we start off the new year, many of you may already be preparing to file your taxes or providing information to your tax preparers, and you may need some documents from your Schwab accounts. For your investment accounts that converted from TD Ameritrade to Charles Schwab accounts, you can access your 1099s for both custodians directly on the Schwab Alliance website. If you have an account with activity for the year that caused a 1099 to be generated, you will notice that there are 2 sets of 1099s available based on the time period in question. A TD Ameritrade 1099 for the period of January 2023 up to the conversion date of Labor Day weekend, and another set of 1099s for Schwab for the post-conversion period starting in September and running through the end of the year. If there is a 1099 available for your account, you should be sure to download both for your records and provide them to your tax preparer if you use one. Any statements or 1099s for your accounts can be found by logging into the Schwab Alliance website and clicking on the rightmost tab at the top of your screen that says Statements. You can also confirm or update your communication preferences for monthly statements from the same screens in Schwab Alliance. As you can see in this screenshot I've included in this slide, there is an option in the statement section to update your preferences for each communication type per account. One thing you should be aware of as it relates to paperless communications is that if you set your accounts to paperless at TD Ameritrade, but you have never logged into Schwab Alliance, you should log into Schwab Alliance and check these settings by March 27th of 2024. As Schwab has indicated that they will revert to mailed statements for account holders who have never logged into Schwab Alliance by that point. I'll spend some more time explaining how to log into Schwab Alliance on the next slide. Once you reviewed for any statements or tax documents you might need, you can also review and update various account settings by clicking on the small icon of a person in a round circle at the top right portion of your screen. It's next to the logout button. This will give you a drop-down menu with various options, including the ability to add a trusted contact to your account and the ability to update your beneficiaries for each account. Utilizing Schwab Alliance to make these changes is generally going to be a much simpler process than if we need to fill out and send you forms either physically or electronically. So we recommend that you use these new features to your advantage. One other change that some of you have noticed is that for married couples who want to have all their accounts grouped under one login, Schwab doesn't automatically grant access to the other spouse. That account holder will need to manually grant access to the spouse to see their accounts showing up under the same login. Schwab also lets you grant this access to another party from Schwab Alliance. And you can again click the little icon of the person toward the top right of your screen, and you'll see the list of options, including one that says account access. You can then click that option and then follow the prompts from Schwab to identify which accounts you'd like to include in your partner's login. You'll need to enter some information about the account holder whose account you're adding, and then Schwab will make the link. So as you can see, the Schwab Alliance website has a wide range of features that you can use to your advantage. If you've not logged into Schwab Alliance before, you can do so by going to our website at fullenfinancial.com and then clicking the green button towards the top right portion of your screen that says Clients. You'll see a list of clickable options that take you directly to the websites that many of our clients use, including Schwab Alliance. Click the one that says Charles Schwab. From here, you'll be taken to the Schwab Alliance website and be prompted to either enter your existing login credentials or hit New User. And then you'll be prompted to enter your account number and other information to verify your identity before being asked to create a permanent user ID and password that you can use to log in the future. Again, if you have any questions or need any help logging into Schwab Alliance, feel free to reach out to either myself, Brianna, or Kelsey, and we're happy to assist or answer any questions you may have. And with that, I will go ahead and turn it over to Kelsey.
Thank you, Justin. Tying into the information with Schwab comes the client-facing topic of using DocuSign versus the Schwab digital envelopes. Many of you are familiar with DocuSign as we used it when we worked with TD Ameritrade, but using DocuSign with Schwab is a little bit different. For example, it requires us to have a current and updated mobile number from you in order for us to send it, because it will send you a series of authentication questions. These are generated using a third-party site, and they are sent to you via text in order to access and sign the document or form. DocuSign now is primarily used for more complex documents, as the forms as Schwab now prefers us to use the digital envelopes for setting up of new accounts or account updates, like linking a bank account to your account, if provided that you have already set up your client account with Schwab. With Schwab digital envelopes, you must have your client portal set up and you must have your email attached to your client account in order to use this method. Referring back to what Justin said, by logging into your Schwab Alliance profile, you are able to ensure that your phone number, address, etc. are all up to date. With this method of sending documents or forms for your signature, you just need to log into your Schwab account rather than having to go through the series of authentication questions with DocuSign. With the Schwab digital envelope, there's less room for errors as it pulls information directly from your accounts and it auto-populates into the digital envelopes, ensuring that your information is most accurate. I must include that though you may prefer what delivery method we use to send you, there are certain forms where we can only use one method or the other. I know it can be a bit confusing going back and forth between the two, but we will do our best to send you a separate message letting you know which method that is. Next, I want to spend a few minutes discussing reports that are being uploaded to your shared Dropboxes each quarter and where they are located. But before we get into that, I'd like to mention a few things about Dropbox and say that if anybody needs assistance with Dropbox or uploading any forms or documents, to contact me directly. My email is on the screen and I would be happy to help. I will also mention if there's anything you would like us to look over or discuss with your advisor, to upload them to your transfers folder located in your shared Dropbox files, and to contact us when you do so. The first report is the Money Guide Pro Net Worth and Asset Allocation Reports. These are going to be located in your Financial Planning Reports folder on Dropbox. This report gives you your net worth summary with a detailed report of accounts and what information is used in order to calculate your net worth. This report also includes a resource summary, your investment assets by tax category, and a worksheet detailing your allocation comparison. The next report is the Panoramics Performance Report. This is going to be located in your Performance Reports folder on Dropbox. This report gives you a graph showing your portfolio value and your performance history. This kind of gives you the big picture of what your portfolio is going to look like. The remainder of the report shows your account performance history, detailing your portfolio returns and your individual account returns. The third is your fee statements. This is not necessarily a quarterly report, but they are being uploaded to your Dropbox each quarter, and they are located in the fee statements folder. These statements show your accounts, your account value, and the fee being billed to each account. And if anybody has any questions regarding these reports, you're welcome to email me and I'd be happy to assist you. When discussing what to do with idle cash, we recommend looking into a high yield money market bank account. Most of these offer a higher interest rate than leaving cash sitting in a checking or savings account. If you're looking to do this, we suggest that you find one that offers anywhere between a 4.5 and 5% return, and any money market account you choose should be FDIC insured. One option is that we work with is Stonecastle. It offers you a 4.85% rate of return and is FDIC insured up to $25 million. One caveat with Stonecastle is that you must have a minimum of $100,000 cash deposit. Because of these higher interest rates, we highly suggest taking advantage of it and looking into alternatives for idle cash. If you have any questions regarding Stonecastle, please contact me or your advisor directly. I will now pass it along to Milt, and he will discuss the 2023 market recap.
Thank you, Kelsey. What I want to do, looking at 2023, is I want to start with some of the basics. The stock market had a good year in 2023. The S&P 500, using that as proxy for the markets overall, it was up by 24%. Stock markets generally reflect the condition of corporate earnings. However, for 2023, earnings were up a modest 3.1%. That level of profit growth certainly cannot explain the type of market growth we saw in 2023, particularly in the fourth quarter. Finding the why markets grew as they did in 2023, one doesn't have to look very far. It was all about interest rates and the Federal Reserve. With interest rates going up by 5.25% since March 2022, and now the Fed highlighting that interest rates will drop in 2024, the markets responded accordingly. With the expected lower interest rates, the profit growth projection for 2024 currently stands at 11.1%. Why is the Fed signaling that interest rates may drop? In December 2023, the CPI measured 3.4%, dropping from a peak of 9.1% in June of 2022. We will see if inflation can continue to drop in 2024 without going into a recession. I will label 2023 as the year the experts got a lot of predictions wrong about the economy and how the markets would perform. With the exception of 2008, I don't think I have seen predictions so far off in the last 20 years. I will come back to this after I review our year-over-year results. This is a schedule that we update every quarter that shows how basic investment markets performed. It shows prior year beside current year 2023, along with Q4 2023 for major market indices. Let me start by asking you to look at the full year 2022. This is just a reminder of how bad a year 2022 actually was. Now look at the returns we had for the full year 2023 and also focus on Q4. Prior to Q4, you can see that full year 2023 was on track to be a reasonably mediocre year. Two factors drove the good results for the entirety of 2023. First, the prospect of interest rates going down in 2024, which the Fed acknowledged in December of 2023, supporting the large increase in Q4 2023 results. The second item that drove results for the year was the performance of the Magnificent Seven. You have probably heard mentioned that for much of 2023, the Magnificent Seven had an outsized impact on market returns, as you can see on this slide. Comparing their returns to the 24% gain in the S&P 500 is evidence of this. Here you can see the companies that make up the Magnificent Seven, also their size, listed from largest to smallest, along with the percent gain they experienced in 2023. If you follow the markets closely, you may know that Microsoft has recently outgrown Apple. During 2023, all of these stocks were given very positive reviews based on their expected development and adoption of artificial intelligence. Meta Platforms, formerly Facebook, had the added boost of coming off a very poor 2022. For those of you who don't know the name NVIDIA, they are a chip manufacturer that is providing the high-end microchips necessary to propel artificial intelligence. Will these firms continue to march forward in 2024? That depends on who you ask. Having seen the Magnificent Seven results, which all fall under the S&P 500 large cap stocks, now look at the other asset sectors inside the box. Except for large cap, the remaining indices had the vast majority of their gains in the fourth quarter. Particularly notice the increase in small cap stocks. Growth in small cap stocks are often viewed as a harbinger of U.S. market improvement as market growth spreads out among a larger base of companies. This sometimes indicates a more sustained recovery is underway. You can also see that much of any future recovery will depend upon when interest rates actually begin to drop in 2024. There is no consensus about the timing of that, or in fact, it still could not even occur in 2024. I hope everyone also sees. What I hope everyone also sees is these market movements can be very unexpected. If you want to take advantage of these unexpected market increases, you can only do so by maintaining investment diversification. An investor who waits for these increases to become clear will miss them. An investor who constantly tries to anticipate such increases will end up with many false positives. There is one constant among these active investment strategies, as revealed pretty clearly and repeatedly by independent studies. They don't work often enough to compensate for their misses. Now I want to briefly identify what a hypothetical portfolio for 2023 produced in yield. For this hypothetical yield calculation, I'm using the 6 major indices that make up a broadly diversified portfolio. I'm also assuming that 35% is invested in fixed income and 65% is invested in equities, and that these investments were held for the full year. For 2023, this produced a portfolio return of almost 12.5%. This is consistent with our clients' 2023 returns, although it will vary depending upon what your actual asset allocation was and whether or not you maintained it for the full year. For those who want to be reminded of 2022, it was a decrease of 17.2%. Now, I want to go to the second poll question, and that question is, did the U.S. experience a recession in 2023? Yes, no, or no, but it will in 2024. I want to give just a few seconds for people to respond, and we'll see what the answers were. Yes, no, no, but I suspect in 2024. Actually, we did not experience a recession in 2023. 2023, you want to the next slide? "2023 will go down as the year most experts made a lot of poor predictions about the economy. Let me start with rising interest rates are sure to cause a recession. While there is no precise definition of a recession, it is generally felt that it would be reflected by 2 consecutive quarters of GDP contraction. At the end of 2022, the prediction that the US would go into a recession before the end of 2023 was based on the logical assumption that with the Fed raising interest rates at the fastest rates in 40 years, a recession was sure to occur. In 2023, we had no quarter of negative GDP growth, with the third quarter up by almost 5%. We're not out of the woods yet. 2024 prognosticators still remind us that soft landings, which require no quarters of negative GDP growth while bringing down inflation, are not easy to accomplish. However, many economists are acknowledging that it is now a likely scenario. Most also acknowledge that the economy going into a major contraction is unlikely. The next errant projection, Russia's invasion of Ukraine and the OPEC oil supply constraints will cause global oil prices increases. When Russia invaded Ukraine, oil did spike to over $120 a barrel. Non-OPEC oil production from the US, Canada, Brazil, and Argentina spiked in 2023 and basically offset the oil lost from Russia and OPEC, according to the S&P Global Commodity Insights. In fact, the US hit an oil production milestone in Q4 2023, making the US the largest oil producer of any country in history. However, don't think the reductions in production brought about by OPEC didn't matter. They did, and they still do. With OPEC continuing to restrain their supply, it will keep the US oil production booming. However, if OPEC decides to flood the market with oil, which it has done in the past, it will create an oil glut, causing sudden price reductions. History shows this wreaks havoc with longer-term production capabilities, as some non-OPEC oil production companies would likely go out of business. Alternatively, OPEC could continue to restrain supply, and it could eventually cause prices to rise because non-OPEC countries' oil production may no longer be able to offset those additional cuts with more production. However, we would also want to keep in mind OPEC supply cuts are hurting OPEC countries, and that amalgamation or that organization has components inside it that are suffering. How OPEC responds to non-OPEC countries' high oil production remains to be seen. Next up, unemployment needs to go down for inflation. I'm sorry, unemployment needs to go up for inflation to come down. This is conventional wisdom, and history bears it out. Early predictions in 2023 targeted unemployment rates of between 6 and 10% before the Fed could reach its goal of 2% inflation. However, those high unemployment rates were not reached. Instead, we have not gone above a 3.9% unemployment rate while inflation has continued to come down. Additionally, the US economy regained all the jobs it shed in April 2020 when unemployment briefly hit almost 15%. The bulk of employment gains have been in private education, healthcare, leisure and hospitality, and construction. Ironically, information technology actually lost jobs in 2023. For many months, there was concern that labor participation rate was not returning to pre-pandemic levels. However, this has actually slowly reverted back to 2019 levels. It is also worth noting that labor participation in the US has been dropping since 2000. The dynamics underlying this are not fully understood, but one factor playing out is the large baby boom cohort aging out of the workforce, sometimes sooner than they had planned. Wages aren't rising for the lowest paid workers. Since the beginning of COVID, that has not been true. Since 2020, overall wages have increased 19.4%. Production and non-supervisory workers, which make up most of the workforce, are up 21.9%, and hospitality and leisure workers are up 27%. It is the traditionally higher paying white collar jobs that have actually seen the slower wage growth over the last few years. It is also worth making a distinction here. Note that I am talking about wage growth, not total wealth growth. Particularly among the ultra wealthy, whose wealth is heavily invested in stocks and bonds. Generally speaking, increases in stocks and bonds widens the wealth gap. Decreases in such investments narrows the wealth gap. This has been true for decades. The next errant prediction: inflation had a single clear-cut origin. When inflation first started to spike, there were many claims that inflation had one single clear-cut origin. Those causes range from pandemic stimulus, corporate price increases, Russia's Ukraine invasion, workers slow to return to COVID, and overall wage increases. If only life were so simple. All these things contributed to inflation, and there were even more contributors than this: mounting trade wars, low and non-targeted immigration, lack of foresight in housing construction, earlier than anticipated baby boomer retirements during COVID. There was no single cause for the inflation we had and we continue to experience. Of the many causes, some of them remain with us, which could make getting to a 2% inflation more difficult than many presently anticipate. The last errant prediction I will highlight: rising markets, low unemployment will make people feel good. While this has historically been true, this has not been the case in 2023. Most notably, for people making less than 50,000 and those making over 100,000, polls show they feel like the US economy is in a recession. The December and the just released January 2024 University of Michigan Consumer Sentiment Survey may be showing that this is starting to change. These two surveys have shown the largest uptick in consumer sentiment since 1991. Depending upon what happens to inflation, and I will include the stock market in 2022, we will see if the improved sentiment holds up. So, to sum up 2023, the Fed actions on interest rates were the dominant theme, particularly the leveling off of increases throughout 2023 and the announcement in Q4 that they would start reducing rates. Next, the anticipated impact of artificial intelligence over the coming years, particularly as reflected in the Magnificent Seven. Finally, the increased oil and gas production of the US as well as other non-OPEC producers, effectively offsetting the impact of OPEC and Russia. Now I will hand the presentations off to Kevin, who will look ahead to 2024.
Thank you, Milt, and hello, everyone. It's good to have you all here with us today. As I've done in the past, I'm going to spend the next 20 minutes or so looking at some key economic measures for 2023, and then I'll use those to formulate an outlook for the year ahead. And I'll definitely pick up one key theme from Milt's presentation, which is that interest rates have become a key driver of the economy and the markets, and we believe that will continue to be the case in 2024. Before I jump in, we've got one more poll question. Question is, when is the last time the federal funds rate was as high or higher than it is today? Was it April 2019, July 2007, February 2001, or January 1998? We'll give you a little bit of time to respond. Okay, 54% say January 1998, and the rest of you are split among the other three. The correct answer is February 2001. So it's been over 20 years since the federal funds rate was as high as it is today. So as we delve into some of the key metrics driving the 2024 outlook, there's no doubt interest rates are the gorilla in the room. Most economic experts believe we are seeing a paradigm shift on interest rates, driven by the rapid increase in rates over the last 2 years. Keep in mind, in 2022, interest rates rose more rapidly than they had over the last 40 years, as the Fed embarked on a very aggressive tightening cycle in response to historically high inflation. There are valid reasons to believe that interest rates will not return to the levels we have seen over the last 15 years, and this has big implications for the economy and the financial markets. One impact we've all seen quite clearly is that 2% and 3% mortgage rates are likely a thing of the past, leading to big changes in home construction, inventory of existing homes, and overall housing affordability. This is just one example of how higher rates can have a ripple effect through the economy, both in the short term and the long term. But the impact of higher rates is truly pervasive. And not all the impacts are negative, as anyone with a high yield savings account will tell you. In fact, many believe this return to sound money, as it's been called, will be a positive development for investors over the long term. And I'll talk more about that as I go through the slides. I'm going to start with a look at the federal funds rate, which is set by the Federal Reserve and determines the interest rate paid by U.S. banks for overnight borrowings. Here you can see the very rapid increase in 2022 with continued increases in 2023. But what you can't see in these numbers is that the Fed's last interest rate hike was in August of last year, when they determined that inflation had cooled to the point that further interest rate increases might not be necessary. And then in December, Fed Chair Jerome Powell strongly signaled that the tightening cycle was over and that the Fed was likely to start cutting interest rates by up to 0.75% in 2024. Markets welcomed this as good news, no surprise, although it did give rise to a concerning disconnect between Fed projections and market expectations. Bond market pricing currently reflects an expectation that the Fed will cut interest rates by about 1.5% this year, or twice as much as what the Fed has projected, which is sure to drive intense speculation around every move the Fed makes in 2024 and will likely lead to continued market volatility. So I just want to show you quickly some historical context for the interest rate picture. And I know this chart is a little hard to see, but this shows the federal funds rate from January 1st, 1980 through the end of 2023. The heavier gray bar on the right is the period of the Great Recession, and you can see how low interest rates were from that point until the tightening cycle that started in 2022. Of course, no one wants to go back to the interest rates of the early 1980s, but you can see the rates we have today are not out of the ordinary, historically speaking. The anomaly really was the 0% or near 0% rates we saw for a period of about 15 years. If we look at longer term rates, it's a similar story. Rates spiked in 2022, followed by more modest increases or leveling off in 2023. We certainly have seen how increases in longer term rates have impacted the mortgage sector, which is probably the biggest impact on consumers from higher long-term rates. You'll also note that the yield curve is still inverted, with short-term rates being higher than long-term rates. We talked about the projected cuts in 2024, but this will not completely address the inversion. And as we talked about in past interest rate cycles, an inversion of the yield curve has been a precursor to economic recession. So at this point, markets seem to be assuming the Fed has achieved the proverbial soft landing by reducing inflation without triggering an economic recession. I wouldn't take that to the bank just yet, particularly with the uptick in inflation we saw in December. And I'll talk more about inflation here in a minute. First, here's a graphical depiction of historical rates for the 10-year and the 30-year U.S. Treasury debt. And the tags you see on the right of each graph here show the respective rate as of about 2 weeks ago. You see similar patterns here to what we saw with the Fed funds rate. One of the big challenges with the low interest rate environment we've been in is that bondholders were earning real rates of return around 0% or even below zero. To some extent, this is what drove the high valuations we have seen for stocks and other assets over that period of time. Investors were not satisfied with the returns on fixed income investments, and they sought other alternatives. And one of the more concerning aspects of higher rates is the impact it will have on government spending and debt. As you can see here, the U.S. national debt increased by another $3 trillion in 2023, which is a pretty staggering number. To put this in context, let me give you a few reference points on national debt levels. The national debt first reached $1 trillion in 1982. So it took almost 200 years to accumulate $1 trillion of debt. We hit $2 trillion of debt just 4 years later in 1986. It took another 22 years to get to 10 trillion in 2008, but we hit 20 trillion just 9 years later in 2017. And that means we've added $14 trillion of debt in just the last 6 years. The COVID pandemic certainly had something to do with that, but much of this has to do with entitlement programs like Social Security and Medicare straining under the weight of baby boomer retirements. The bottom line is that we're not on a sustainable path as it relates to spending and debt. And this has two potential implications for investors. First, the massive amount of government borrowing will crowd out other borrowers from the market and keep interest rates at higher levels. And second, the federal government will have to address these deficits at some point to avoid an economic calamity. And they really have two choices. They can reduce spending or they can raise taxes. And given their reluctance to reduce spending, we believe tax increases have to be part of that solution. So let's look at the impact these interest rate increases have had on inflation. You might recall inflation was as high as 9.1% in June of 2022. So the reductions to date have been significant. However, economists are projecting that inflation will remain above the Fed's 2% target through 2025, which is likely to also contribute to higher interest rates. The Eurozone, by contrast, has maintained a more hawkish stance toward inflation. And although it remains higher than in the US right now, it's expected to decline faster in 2024. This chart shows the inflation trends from December of 22 through December of 23. The blue line shows inflation for all items, while the red line shows the core inflation rate, which excludes food and energy. A couple of things to point out here. First of all, you can see the core inflation number is still well above the Fed's target of 2%, and the line is flattening in the latter part of the year. This supports the projection that higher inflation is likely to be with us for some time to come. You'll also notice the uptick in the all items line in December. Although this measure is more volatile than the core measure because energy and food are included, it does suggest the Fed's communication in December may have been a bit premature. More than half of the December increase was attributed to shelter costs. And these costs were also responsible for more than 2/3 of the annual increase in core inflation. Costs for services also remain stubborn due to continued tightness in the labor market and strong wage growth. And you can see here on this slide that the unemployment rate did tick up slightly in 2023, and employers have had to increase wages significantly to keep jobs filled. Looking forward, however, economists expect that higher interest rates will impact business profitability and investment activity, leading to higher unemployment by the end of this year and into 2025. And this is another area where the Fed is really walking a fine line between soft landing and recession. A significant uptick in unemployment could impact consumer confidence and put a damper on economic growth in 2024. Now, having said that, the Consumer Confidence Index shows that consumers ended 2023 with a surge of optimism. Both the Present Situation Index and the Future Expectations Index rose in December, although future expectations were coming off of a decline in November. Keep in mind, the Fed communicated on December 13th their expectations that interest rates would decrease in 2024, effectively signaling that inflation is under control. It seems likely this had some impact on the December readings, particularly when the perceived likelihood of recession also dropped to its lowest point of the year. And we've seen the stock market bounce around a little bit from the surge following this announcement, as investors continue to digest the December inflation report and might be adjusting their expectations for growth in 2024. So what does all of this portend for the economy this year? As Milt mentioned earlier, U.S. economic growth definitely exceeded expectations in 2023, despite the higher interest rate environment. Looking ahead, though, economists have tempered their expectations for the U.S. and other parts of the world. Global growth is expected to be 2.6% this year, down from 3.1% in 2023. And in the US, economic growth is expected to be just 1.5% in 2024. Growth in the Eurozone and Asia is expected to be flat to down slightly as well. So the experts believe we will avoid a recession this year, but economic growth will be pretty modest. So that's the last economic metric I wanted to discuss. And now I'll turn briefly to a topic I know is on many of your minds this year. It's usually around this time we start to get questions about the presidential election, how it might impact our investment portfolios. And I want to spend just a couple of minutes sharing our perspective on that. First, it's important to note we've only had 24 presidential elections since the stock market crash in 1929. So the sample size for analyzing market behavior around such elections is actually quite small. In addition, in most presidential election years, including this one, the House and the Senate are also in play, making it very difficult to predict if the government will be unified or divided. This makes a big difference in how much of a president's agenda can actually be implemented while in office. And finally, the election itself is a short-term event that rarely impacts the markets in a meaningful way relative to other happenings in global affairs or the economy. To put this in context, this chart here shows the volatility of the S&P 500 at various intervals before and after an election day, and compares those to the volatility for the same time frames in non-election years from 1928 through 2019. The dark blue bars are for the election years and the light blue bars are for all other years. And as you can see, volatility is actually lower in all but 2 time periods around an election than it is in non-election years, with the most notable exception being 1 month after an election. The takeaway here is presidential elections don't increase market volatility in the short term. But what about over the long term? This next chart shows the 10-year rate of return for a hypothetical $10,000 investment in the S&P 500 at the beginning of an election year, starting with the 1936 election and ending with the 2012 election. As you can see, 10-year performance varies from term to term, but the bottom line is that neither political party has a decided edge when it comes to stock market performance, as shown in the top right of the chart. So while presidential elections are important for a lot of reasons, the outcomes are very difficult to predict, and they're unlikely to have a meaningful impact on long-term portfolio performance. So I want to close by going back to the underlying theme of our presentation today, which is the higher interest rate environment. Over the long term, higher interest rates will significantly impact many aspects of the economy and the financial markets. Over the past 15 years, bonds have been used primarily as a tool to manage portfolio risk, but going forward, they will provide real returns to investors, eventually offsetting the price declines we saw in 2022 and 2023. For households and businesses, higher interest rates will limit borrowing, increase the cost of capital, and encourage saving. Growth in the value of stocks and other assets is likely to be less robust. Housing stock is likely to grow at a slower rate, exacerbating the housing shortage and affordability challenges we see today. And for governments, higher rates will force reassessment of fiscal policy and accelerate concerns about fiscal sustainability. In this environment, we believe higher real interest rates will provide a solid foundation for long-term portfolio returns. But as always, diversification is key. And because the transition to higher rates is still in progress, market volatility is likely to stay elevated in the near term. Remember, we've developed an allocation strategy for each of you that fits your particular financial circumstances, your goals, and your time horizon, as reflected in your financial plan. Your portfolios are designed to withstand short-term market downturns because we have a good idea of when you're going to need that money, and we have allocated your assets accordingly. So keeping a level head and sticking with your financial plan will continue to serve you well. If any of you want to discuss the issues here in more detail in the context of your own plan, feel free to contact us by phone or email. And that's the end of our prepared remarks for today. So now I'll turn it back to Brianna for the Q&A.
Thanks, Kevin. We will now open the floor to questions. You may ask your questions using the Q&A box feature in the lower center of your screen. We also had some questions that were sent to us prior to this call, so I might just begin by answering some of those while the rest of you think about your questions and enter those into the chat. So one question that we got ahead of time, and Milt, you actually touched on it briefly in your presentation about artificial intelligence. But the question is, do you think artificial intelligence will impact the markets in 2024?
I do. And this is an area that I've developed over the last several months quite an interest in, and I've done a fair bit of reading on it. And let me qualify my answer of yes, I do think it will have an impact. But maybe not in the way people think. I think from an AI implementation perspective, I don't think 2024 economy is going to be significantly impacted by that. However, I do think that companies developing AI, particularly now think of the Magnificent Seven, will continue to be rewarded for that development. I mean, there's many debates about the pluses and minuses of AI, and I'm not really going to address that. What I really would like to identify, though, is just one specific example of why I think companies are going to rush to develop their own AI applications, and why I think the technology impact is going to be significant over time. And here's my example. Imagine that you're a part of a team of scientists who is developing AI, who is developing cancer drugs and cures and looking for cures. The traditional approach is to look for new drugs or even genetic modifications that will seek out and destroy the cancer while not harming other body cells or structures where the cancer is located. Traditional research methods to do this takes months. As science develop new drugs, they test them on human tissues, et cetera, et cetera. Using AI, you can simulate new drugs and the impact they have on human cells to speed this process up 1,000%. I mean, the capability is overwhelming in terms of the speed with which some of these traditional methods can be enhanced. So my question is, who isn't going to do that? Now, the implementation will be expensive and time consuming, because one thing that AI requires are massive databases. In fact, that's how AI trains itself, through these massive databases of actual results of drugs and how they impact human tissue, et cetera. That these databases will take time to develop, and the algorithms are quite complicated. Privacy issues and biases will have to be addressed, and all of this is going to take some time, some sophistication, and some thoughtful implementation. But again, I go back to the point: who isn't going to want to do this with this kind of capability sitting in the background? So I don't think it's going to have much effect in 2024 on the general market. I think the companies that are doing the development of AI will continue to do well, and we'll see what happens in the future.
Thanks, Milt. We had another question come in prior to the call. Kevin, maybe you could take this one. My company now offers a Roth 401k. Should I contribute to that instead of my traditional pre-tax 401k?
Sure. Yeah, this is certainly a question that we're getting more and more as more employers start to include a Roth component in their 401k plans. Unfortunately, there really is no one answer to this. It really depends on individual circumstances with respect to tax brackets and so forth. Most of us know that, with a traditional 401k, contributions are made with money that's already been taxed, and future distributions will be taxed at whatever the marginal tax rate is at that time. Roth contributions, on the other hand, are after-tax contributions, but the future distributions will not be taxed as long as certain conditions have been met. And another key difference is that a 401k, a traditional 401k, is subject to required minimum distributions, or RMDs, whereas Roth 401k balances are not. So if you think about how that all kind of fits together, someone who's in a higher tax bracket today, say 32% or above, is generally going to be better off making contributions to the traditional 401k, because that helps them reduce their current income that's subject to that higher tax rate. And then in retirement, when they withdraw those funds, they're likely to pay a lower rate on that income. We do see that many of our clients have a decline in their marginal tax rate in retirement. But again, it depends on individual circumstances. Those who are earlier in their careers and or paying a relatively low rate today, a low tax rate today, should consider contributing to the Roth 401k, because here the likelihood is higher that you'll be in a higher tax bracket when you're in retirement. So pay taxes at a relatively low rate today, let those funds grow tax-free, and withdraw them tax-free when you're retired. Obviously, it's really tough to predict where tax rates are going to go in the future. Although I did mention earlier, we do think there's upward pressure on tax rates. So if you wanted to hedge your bets a little bit, you could contribute to both the traditional and the Roth 401k. Most employers will allow you to do that, as long as your combined contribution doesn't exceed the annual contribution limit, which right now is $23,000 or $30,000 if you're age 50 or older. So again, these are all things that kind of come down to individual circumstances. If anybody wants to discuss this for their own personal situation, just contact your advisor or your associate advisor. We'll be happy to talk through it with you.
Great. We actually had a similar question, Kevin. Maybe you could just add on to the response you just gave. But the question was, a lot of my retirement funds are in a 401k or IRA. How can I guard against taxes in retirement?
Yeah, also a great question. And this one really applies more to, I think, clients who are maybe closer to retirement and haven't had the opportunity to save in a Roth 401k. And as a result, most of the withdrawals that they make from that traditional 401k are going to be treated as taxable income and taxed at their current tax rate. And this really is where taxes can kind of bite you in retirement, because the more you've saved in a 401k or an IRA, the higher those required minimum distributions are going to be. And the funds might be distributed then from that account, or they have to be distributed actually, whether the client needs them or not, even if it results in paying a higher marginal tax rate. So one way that we can address these situations is using Roth conversions. With a Roth conversion, money's distributed from a traditional IRA to a Roth IRA, and the converted amount is subject to tax, but down the road, the converted funds can be taken out of the Roth tax-free. And we often find that there are good opportunities to do this early in the client's retirement, before they've started to take Social Security benefits, before they've started their RMDs, because taxable income is typically much lower in those years, and conversions can be done at a relatively low tax rate. Presumably a lower tax rate than what they'll have when they start Social Security and their required minimum distributions. Another option, if you're looking to reduce taxes related to IRAs, is to, and this is really for those who are more charitably inclined, is to take what's called a qualified charitable distribution, or a QCD, from the IRA. Funds distributed from an IRA directly to a qualified charity are not included in the retiree's income, and the IRS will allow a QCD of up to $100,000 per year. Now, you have to be at least 70 and a half to do a QCD, and the QCD has to be made before any required minimum distribution is taken in order to receive that tax benefit. Again, these are things that depend on individual circumstances. We're talking a lot with our clients who are near retirement or early in their retirement to talk about the benefits of Roth conversions, and we'll be happy to continue those conversations with folks as as they're interested in those.
Thanks, Kevin. So we talked a lot about interest rates throughout this presentation, and not surprisingly, someone had a question in regards to that. So Milt, maybe you could take this one. When interest rates come down, will my bond investments lose value?
Yeah, this is a good question, and it's generally more complex than people think it is. People often think of bonds as some sort of sedentary investment that doesn't actually do much, and much of the time there's some truth to that. However, when interest rates are going up or going down, interesting things happen to bonds slash fixed income investments. And to answer this question, I want to go back to 2022 and early 2023. What we saw in 2022 and early 2023 was a very rapid increase in interest rates. When interest rates go up, current bond investments will lose value. And the reason that occurs is if I'm sitting here in 2022 with a 3% bond, and interest rates suddenly go to 5% over a very short period, go to 5%, then I will have to reduce the price of my 3% bond in order to sell it in a 5% interest rate environment. That creates a bond loss. And if many of us may have looked at our portfolios from 2022, early 2023, we will see our fixed investments are carrying losses. So then the question is, what happens if interest rates start to go down like they're expected to in 2024? Well, what happens if interest rates start to go down is exactly the opposite of what happened in 2022 and early 2023 when interest rates went up. Your bond values actually go up. The reason is let's say I'm holding a 4 or a 5% bond, or maybe even a 6% bond, and interest rates start to drop, and the new interest rate, let's say, is 4%. So I've got a bond paying 6%. If somebody goes out and wants to buy a brand new bond, they're going to get 4%. So people are going to pay a higher price for my 5 or 6% bond. So I've got a bond increase. So what you see will happen when bond prices, interest rates start to go down, is those losses on our bond holdings that occurred in 2022 will start to disappear, will start to shrink, and depending upon what happens to rates, may eventually disappear. So what you see is we often say, look to the long term for your investment time horizon, because you go through an interest rate increase and interest rate reduction cycle, they'll have the opposite effects on your bonds. So our losses in 2022 are going to shrink. Now, if you happen to sell the bond and you're not holding the security anymore because you didn't like that loss, you've effectively made that loss permanent. In that regard, fixed income behaves very similarly to equities. And that's sometimes hard to see because you don't see this kind of volatility in bonds very often. Like equities can go up, stocks can go up and down much more rapidly than typically fixed income does, but you see the same effect taking place. There's something else interesting that happens when interest rates fluctuate. Kelsey mentioned a little bit ago in her presentation that we're seeing money market rates that are between, let's say, 4.25% and 5%. rates. Now, money market accounts are very short-term investments. And in fact, most of them, many of them are invested in either very short-term paper, sometimes overnight paper, that will change its value very rapidly. For example, when the Federal Reserve starts to make its interest rate or makes its first interest rate reduction, there will almost be an immediate response to money market yields. They will drop right along with the Fed rates. The reason they will drop so rapidly is because there's the duration or the length of the investment that's supporting that money market is very, very short. As I said, sometimes overnight. So those money market rates will drop very quickly. What will drop less quickly will be, let's say you've got bonds that have a 1 year or 4 year or 6 year or 8 year timeline or duration. Those bonds will hold on to those rates for a much longer period of time. Now, I think most of us know that very short-term money market rates are often higher than longer-term bond rates, 3, 4, 5, 10-year bond rates. However, when interest rates fall, you're facing the reality that, do I want to try to keep my 5% money market rate for as long as I can, which may be 6 months, maybe a year and a half, or do I want to switch to a 4 or a 5.5% bond rate that I may be able to maintain for the next 10 years? So you get those kinds of things happening when interest rates are moving up and down. So anyway, that's a good question, and we're certainly looking at our clients' portfolios to examine and make some recommendations around how they should structure, particularly their fixed income portfolio in these changing in these changing interest rate environments.
Okay, switching topics, Social Security and Medicare. Kevin, should younger people still expect to have Social Security and Medicare when they retire?
The short answer is yes. We believe that Social Security and Medicare benefits are here to stay. However, both Social Security and Medicare have announced that their trust funds are due to run out of money sometime in the next 10 years. Social Security around 2033, Medicare around 2026. What that means is that tax receipts coming into those programs at that time will no longer be sufficient to cover the benefit obligations that those programs have. And so one way for them to address that would be a reduction in benefits. Social Security has estimated that they could continue to pay 75 to 80% of their benefits with no changes in the program. Medicare is about 90%. But both Social Security and Medicare have talked about ways to shore up those programs. And on the Social Security side, all of those options apply primarily to current workers, not to retirees. So things like raising the Social Security withholding rate on workers' earnings, or making more of a worker's earnings subject to the Social Security withholding, and potentially raising the retirement age. But again, raising the retirement age would be for current workers, obviously not for retirees who are currently taking benefits. It's interesting if you look back at the history of how Congress has dealt with Social Security shortfalls. They've almost always done that by raising the withholding rate on Social Security on income. Not by increasing the retirement age. They've really only increased the retirement age one time from 65 to 67, and that was about 40 years ago. On the Medicare side, it's probably going to be a combination of maybe increasing the Medicare tax rate or potentially increasing the level of means testing for folks who are currently receiving Medicare benefits. But it's important to keep in mind, Social Security benefits were never really intended to replace all of a worker's income in retirement. And for higher earners, that Social Security is going to make up a smaller portion of income in retirement than it will for lower income workers. So obviously continuing to save and invest and have other resources available for retirement is critically important. And you all probably know that for planning purposes, we take a pretty conservative approach to Social Security. We assume that Social Security is going to start at full retirement age, where actually in a lot of cases our clients will wait until age 70 to start their Social Security benefit to get that higher monthly benefit amount. And we also use a lower rate of inflation for the Social Security benefit than we do for the goals that are in the financial plan. So yeah, we do believe that the programs are going to continue for the long term. But we also think that younger workers in particular are likely to see some changes before they retire.
Great. We have two final questions here. The first one is, Schwab had a very difficult and turbulent 2023 with layoffs, profit decline, and a sharp drop in their share value. What are your thoughts on Schwab in 2024, Milt or Kevin, or both?
Yeah, I mean, I could start off with that. I think certainly we've seen the reports on Schwab as well. The transition or the conversion that we went through from TD Ameritrade to Schwab was a massive undertaking. And I think overall that transition went relatively well. And if you think about what they had to do in that conversion, with so many former TD Ameritrade users now moving to a new system and having to get acquainted with that system and driving a lot more questions to their customer service call centers and email traffic and all of those kind of things. Clearly, that's going to be kind of a short-term spike in their costs as people get up the learning curve on the new system. And they've actually, I think, done a reasonably good job of maintaining decent levels of customer service, actually pretty good levels of customer service for us and for the advisor environment. We haven't run into any significant problems with getting answers on the phone or being able to reach people. And typically the service that we get is of a pretty high quality. So I think Schwab is just going through some growing pains, and they're going to, take some time to get through this conversion process and get everybody, acclimated to the Schwab system. And then you're likely to see that, with those expenses behind them, their profitability is going to return to more normal levels. I don't know, Milt, if you have anything to add to that.
Yeah, I would add that, being a custodian and handling transactions of the scale that they handle is a hard business to be in. And I think Schwab, I think TD Ameritrade prior to them, I think Fidelity, I think they are all struggling a little bit and will continue to struggle with that. Schwab added the additional burden of trying to integrate TD Ameritrade, as you just described, which is probably causing some short-term pain that everybody hopes it will go away. So I kind of look at that business as it's just a hard business to be in. It's a hard business to be successful in. It's getting harder all the time. And I think as your advisors, Fullen Financial experiences this as well, and we do a lot to I don't know, to make things more understandable, to make things easier for the client than if they were dealing with Schwab directly, or TD or Fidelity or anyone else. So anyway, I guess I would just conclude it's a hard business to be in.
Last question here. Do you think Bitcoin will play a more significant role going forward?
Well, let me take the first kick at the can on that one. And I think the technology behind Bitcoin is pretty interesting. It's really interesting. And I think there's a large number of applications. And I think the Bitcoin concept will have some pretty interesting implications over the next 10 or 20 years. I mean, I would not be surprised if we start seeing a lot more digital currencies out of countries and use of that technology, because it's can be very effective. Now, I don't know that Bitcoin in its current existence is going to provide a lot of that sort of backbone, but I think the technology will. The problem as an investor and a manager of people's monies, the problem with Bitcoin is Bitcoin has been around for what, 15 years, and I've made the point many times that when you look at markets and equities and bonds, etc., those types of securities have been around for hundreds of years, and the predictability of them is still a roll of the dice. I mean, I read a Bank of America economist analysis of investing a few days ago, who said something I thought was very, very clever, and also very useful in terms of the philosophy of investing. He said, if you're investing for the short term, expect to maybe win 50% of the time, maybe win 50% of the time. If you're a long-term investor, you're undefeated. You've never lost. And the problem with Bitcoin is it's hard to be a long-term investor, particularly when you're managing other people's money, because there's no predictability. From my perspective, sorry, 15 years is nothing. You can't predict anything from 15 years worth of history. You need decades at least. So from a managing people's money perspective, claiming that you have any sort of history in terms of what happens next based on a large data bank of information, it's just not there. So therefore, that makes it very hard to get any predictive models behind this, or any useful probabilities, because its life has been so short. And I mean, that's just that's my 30,000 foot view as to the reason we're generally going to stay away from that, because it just isn't, we just can't get any predictability for out of what's there. So Kevin, I don't know if you want to add anything to that.
Not much. I mean, I think what you said is a nice way to characterize it. I mean, certainly it has a short history, a short track record, and that track record has been quite volatile, actually. So, the thing with Bitcoin that is a challenge as well is just the lack of intrinsic value in that investment. It's more of a speculative investment, similar to precious metals or things like that. And so it gets back to some of the fundamental issues that you highlighted, Milt, and I'm not going to repeat those. But yeah, in general, it's not something that we would consider a necessary component of a diversified portfolio.
Okay, we've answered all of the questions, and I believe that's all we have prepared for today. So we appreciate your time and wish you a great rest of the day.
Thanks, everyone.
Yes, thank you very much.
Thanks for your time.
Thank you.